In this lecture, we are going to discuss two major topics. The first one is foreign exchange market, and in this topic, we are going to explain what are foreign exchange rates and why are exchange rates important and how is foreign exchange traded. The second topic is exchange rates in the long run. In this topic, we are going to discuss law of one price and the theory of purchasing power parity and factors that affect exchange rates in the long run. Foreign exchange market. The price of one currency in terms of another is called the exchange rate. As you can see in the figure, exchange rates are highly volatile. Trade between countries involves the mutual exchange of different currencies, or more usually, bank deposits denominated in different currencies. When an American firm buys foreign goods or services or financial assets, for example, US dollars, typically bank deposits denominated in US dollars must be exchanged for foreign currency, which is bank deposits denominated in the foreign currency. Also, the trading of currencies and the bank deposits denominated in particular currencies takes place in the foreign exchange market. And transactions conducted in the foreign exchange market determine, of course, the rates at which currencies are exchanged, which in turn determine the cost of purchasing foreign goods and financial assets. What are foreign exchange rates? There are two kinds of exchange rate transactions. First, the predominant ones, called spot transactions, involve the immediate exchange of bank deposits. So, the spot exchange rate is the exchange rate for the spot transaction. Second, forward transactions involve the exchange of bank deposits at some specified future date. So, the forward exchange rate is the exchange rate for the forward transaction. Note that when a currency increases in value, it experiences appreciation. When it falls in value and is worth fewer US dollars, it undergoes depreciation. To explain the idea, at the beginning of 1999, the euro was valued at $1.18, and as indicated in the following the financial news box, on June 16, 2016, it was valued at $1.11. The euro depreciated by 6%. Equivalently, we could say that the US dollar, which went from a value of 0.85 euro per dollar at the beginning of 1999 to a value of 0.90 euro per dollar on June 16, 2016, appreciated by 6%. Why are exchange rates important? Exchange rates are important because they affect the relative price of domestic and foreign goods. Note that when a country's currency appreciates, which means rises in value relative to other currencies, the country's goods abroad become more expensive and foreign goods in that country become cheaper, holding domestic prices constant in the two countries. Conversely, when a country's currency depreciates, its goods abroad become cheaper and foreign goods in that country become more expensive. How is foreign exchange traded? You cannot go to a centralized location to watch exchange rates being determined. Currencies are not traded on exchanges such as the New York Stock Exchange. Instead, the foreign exchange market is organized as an over-the-counter market in which several hundred dealers, mostly banks, stand ready to buy and sell deposits denominated in foreign currencies. Because these dealers are in constant telephone and computer contact, the market is very competitive. In effect, it functions no differently from a centralized market. Exchange rates in the long run. Like the price of any good or asset in a free market, exchange rates are determined by the interaction of supply and demand. Law of one price. The starting point for understanding how exchange rates are determined is a simple idea called the law of one price, which means if two countries produce an identical good and transportation costs and the trade barriers are very low, the price of the good should be the same throughout the world, no matter which country produces it. Suppose that American steel costs $100 per ton, and identical Japanese steel costs 10,000 yen per ton. For the law of one price to hold, the exchange rate between the yen and the dollar must be 100 yen per dollar, so that 1 ton of American steel sells for 10,000 yen in Japan, the price of Japanese steel, and 1 ton of Japanese steel sells for $100 in the United States, the price of US steel. Theory of purchasing power parity. One of the most prominent theories of how exchange rates are determined is the theory of purchasing power parity. It states that exchange rates between any two currencies will adjust to reflect changes in the price levels of the two countries. So, the theory of purchasing power parity is simply an application of the law of one price to national price levels. Look at the example. To explain the law of one price. Recently, the yen price of Japanese steel has increased by 10% to 11,000 yen, relative to the dollar price of American steel, unchanged of course, at $100. Now, by what amount must the dollar increase or decrease in value for the law of one price to hold true? Solution will be as you see. For the law of one price to hold, the exchange rate must rise to 110 yen per dollar, which is a 10% appreciation of the dollar. The exchange rate rises to 110 yen so that the price of Japanese steel in dollars remains unchanged at $100. In other words, the 10% depreciation of the yen, which means 10% appreciation of the dollar, just offsets the 10% increase in the yen price of the Japanese steel. Now, as our US-Japanese example illustrates, the theory of purchasing power parity suggests that if one country's price level rises relative to another's, its currency should depreciate, and the other country's currency should appreciate. As example in the left slides illustrates, if the law of one price holds, a 10% rise in the yen price of Japanese steel results in a 10% appreciation of the dollar. Applying the law of one price to the price levels in the two countries produces the theory of purchasing power parity, which maintains that if the Japanese price level rises 10% relative to the US price level, the dollar will appreciate by 10%. So, the theory of purchasing power parity suggests that if one country's price level rises relative to another's, its currency should depreciate, which means the other country's currency should appreciate. Factors that affect exchange rates in the long run. The table you see gives you summary factors that affect exchange rates in the long run, which are domestic price level, trade barriers, import demand, export demand, and productivity. Now, very important question. How those factors work? For example, when domestic price level increases, the response of the exchange rate is depreciated.